Hey everybody, thanks for taking the time today to join us for this webinar. Today we're going to talk about retirement and tax planning. So a lot of the times I get questions, when we sit down, someone's getting close to retirement or just now retired and we start talking about tax planning in one of our meetings, then they're like, well, I thought my taxes would just go down because I'm not going to be earning income from my job. I'll just be pulling from my IRA, but that'll supplement Social Security, so my taxes should be lower, right? And in most cases, that's correct as far as lower taxes, but there's other aspects of it depending on your income level, and we'll get into all that here in just a second. But tax planning is just as important in retirement as it was while you were working, and then even whenever you pass away, there's other aspects of taxes that come into play there as well. So let's jump right in. The first slide here, of course, is legal disclosures, and that is I am not a CPA, so I cannot give tax advice. I do tax planning. We do work with your CPA in order to assess your situation, but we also have an in-house CPA for those clients that choose to use them that we work directly with when it comes to tax planning. So some of the topics that we're going to cover, tax planning and its impact on Social Security and Medicare, which a lot of people don't realize that Medicare, even though it's not a tax, it really relates to the amount that you pay in premium, but there's a definite correlation between tax planning and what you pay in Medicare premiums, again depending on income levels. The importance of tax planning and its impact on lifetime taxes. So a lot of the times people are really focused on not paying taxes in this year or next year, but as far as lifetime taxes, sometimes you'll pay a lot of taxes in first few years, especially if you're doing like Roth conversions, and then throughout the rest of your life, your tax bill will be lower and your overall tax bill will be lower. So the other topics, taxes and RMDs, legacy planning. About half of the presentation will be on RMDs because that's a real hot topic with a lot of people since they've moved the RMDs, and also because markets are where they're at. They've done really well over the last few years, so people's IRA accounts are a lot larger. So we've already kind of hit on that and the importance of creating a tax plan. So one question I get a lot when I'm sitting down and we kind of start discussing this topic is, so you're telling me I can end up paying more in taxes on the amount that I pull from my IRA than just the amount that I pulled? And the answer is yes, and we'll kind of walk through an example. But the reason for that is because a portion of your Social Security can be pulled in to your gross income in order for the tax calculation. So we can do the calculation here. All the calculations that I'm doing are back of the napkin. Our software actually does the real granular and detailed calculations, but this will give you an idea, and it's something that you can do on your own as well. If you'd like to be more accurate, in another slide I'll kind of point out the website that you can go to in order to get your real, concise number on the amount of Social Security that will be pulled in based on your income level. So to determine it, you take your gross income, which is not going to include tax exempt interests such as muni bond income, and you add one half of your Social Security to that number, and then add back any tax exempt interest. You subtract this from the base amount, which for a married couple filing jointly, that first range is $32,000 is where Social Security will start being taxed, up to $44,000, and in that range, about 50%, up to 50% of your Social Security can be taxed. And then the next tier is at $44,000. So anything above $44,000, then up to 85% of Social Security can be taxed. Keep in mind that is the maximum amount that can be taxed is 85%. So kind of walk through a simple example here. John and Jane have a gross income of $30,000. $40,000 in Social Security benefits. So if we take the $30,000, add half of their Social Security benefits, we come up with $50,000. And so we know that $50,000 is greater than the $44,000, which is that higher tier. So we know that up to 85% of their Social Security will will be taxed. So, and then also at certain income levels, so it's not a set scale like at a certain dollar amount. And that's why the calculation gets pretty complicated. But the website is irs.gov/help/ITA, and you can input your information and you get a real accurate number. But for the example that we're just talking about, if they pulled out an additional $1,000 out of their IRA, then they could possibly pay taxes on $1,850 instead of the $1,000. And of course, the reason for that is depending on where their income is and on that scale, then a portion of that will start being added to their gross income, which means they will have to pay taxes. It's an increased amount of taxes. So it could be up to that $1,850 because that would be 85% of their Social Security being pulled in. So something to keep in mind, especially when you're getting close to those thresholds. And if you're needing money, couldn't you hold off till the next year? Or pull it from a different account, whether that's a taxable account that maybe you don't have any capital gains or you even have a loss in that account? Or could you pull it from a Roth account that will not be included in your gross income? So, and then another thing to keep in mind also is, if you remember from that couple slides back where we talked about tax exempt interest being added back to the gross income number, and that's a way that tax exempt interest can actually be taxed indirectly, because again, depending on your income level, that tax exempt interest is added back to it. So if it pushes you up into one of those tiers, then a portion of your Social Security will be taxed. In essence, it's your tax exempt interest is indirectly taxed. So what are some strategies to reduce the tax on Social Security? One thing that you can do, and again, there's a myriad of strategies, but Roth conversions is an option depending on your income level, where you're currently at. Are you taking Social Security now, or are we trying to reduce it for later years? But any distribution that comes from an IRA or a 401k is included in your modified adjusted gross income, your MAGI. But any distribution from a Roth or a Roth 401k is not included in your MAGI. So if you, depending on where you're at, if you do Roth conversions, say before you even file for Social Security, knowing that the amount that you're going to need to pull, you can supplement that with Roth versus traditional, and kind of balance that out to keep that the least amount of Social Security being pulled in, depending on your income level. So when you do the conversion though, and if you're already taking Social Security, then your income will go up, your income taxes will go up in that year, because a Roth conversion really is nothing more than taking money from your traditional IRA or 401k and moving it to your Roth IRA or Roth 401k. And when you do that though, the amount that you converted or moved to the Roth, you have to pay taxes on it that year. So the income tax and possibly if you're taking Social Security for that year could be taxed at a higher rate, but then it depends on your plan and how far out, like what that income level is, if you're going to be paying lower taxes in the future or not pulling in any of that for any of your Social Security to be taxed. So your future taxes on Social Security benefits and overall income taxes will be lower in future years. Another strategy is minimizing distributions from traditional IRAs, pensions, and annuities. And most retirees will have a mix of accounts. They'll have like their retirement account, which is their IRA or 401k. They may have a Roth. They may have a taxable account as well. And the timing of like when you withdraw money from these, again, depending on that income level, you can adjust whether or not that you either exceed that threshold or not. So for example, if you're right on the cusp and it's like, but I really need, another $10,000, my car broke down or I need a new refrigerator or whatever the case is, then you may decide, well, if I pull that from my Roth, for just this year, then I'll be able to stay below that threshold. So timing on when you withdraw money from certain accounts can make a big difference. Also, even if you have a taxable account, one thing to keep in mind is that any capital gains for that year will be included in your MAGI. So for example, if you needed that $10,000, you bought a stock for $9,000, it's now worth $10,000, you sell it, you take the 10,000, you're going to have to include 1,000 in that calculation. So the capital gains piece of it. And so throughout the year, you may have losses that you can actually tax loss harvest in order to eliminate that gain. But it's something to keep in mind, even if you're not taking the money, but you decide to sell a stock for whatever reason and it has a gain, you have to pay taxes on it that year, and it can push you up into one of those tiers. So another thing to keep in mind, and of course the entire amount of a distribution from a tax deferred account will be included in your MAGI. We already talked about that in a previous slide. And we've pretty much touched on this as well. Manage taxable investment accounts when you're looking at capital gains versus capital losses. One thing to keep in mind is if you have a taxable account and you own mutual funds. Mutual funds are notorious for sending out pretty big capital gain distributions at the end of the year. So even if you bought a mutual fund in November and they distribute a capital gains distribution, you get all of it, not just for the month that you've been there. It's as if you were in it for 12 months. That's one reason why at Paresis we like to use ETFs and individual stocks, because most ETFs, number one, they're a lower expense ratio compared to active mutual funds. And the other thing is they're tax advantage compared to mutual funds. So another thing just to keep in mind. Last thing we'll touch on here is family income planning. So a lot of times people don't really take into consideration like their heirs when they're trying to do this tax planning. So for example, if you had a high income producing asset, but you didn't need the income, and at the same time it's also pushing you into these higher tiers, then you could use some strategies. I won't get into the different strategies, but you could gift those higher income producing assets to your heirs now as opposed to later, and there's other complications in there as well as when it comes to basis and things like that. But you gift those to them, and then of course it could put you in a lower tier, or none of your Social Security will be taxed, and you went ahead and made that gift. So it's just a way to kind of keep your income level where you need it. As opposed, if you needed the income, that's one thing. If you don't need the income, then there could be planning opportunities there. And it could also, if the person that you gave the asset to is in a lower tax bracket, that could be better for your overall family taxes and as well as overall after-tax wealth. So next we're going to talk about Medicare and IRMAA. I always get a kick out of IRMAA because I have to write this down because it's just such a weird name. But what it stands for is Income Related Monthly Adjustment Amount. And there's jargon out there like the IRMAA cliff, and that's kind of what we'll go over here. But this isn't really what you consider taxes. It is really more of your premiums could increase, but you have to look at it from the standpoint of just increasing your overall cost, what's coming out of your pocket. So we'll go back to John and Jane, and both of them have Medicare's Parts B and D. They have a MAGI of $385,500, and they sell a stock that has a $1,000 capital gain in it. So for most people, they would think, well, taxes on that would be at 15% for capital gains, long-term capital gains. Plus, since their MAGI is above $250,000 as a married couple, they have to pay an additional surtax of 3.8%. So still they're thinking $188, about 19%. But when you actually look at the Medicare IRMAA brackets here, then you'll see that right now they're in the tier that's circled. So their total premium is a little over $330. Okay, so, but they sold that stock. Let me go back just a second. So you can see that amount there is $386,000. They're at $385,500. They have a capital gains of $1,000. That pushes them in that $386,000 to $750,000 bracket. So now their total premium goes up to $458, which is $250 for both of them per month, an increase in their premium, which equates to about $3,000 for that year because they were bumped up just because of that $1,000 capital gain. So what they thought they were paying 19% on, at the end of the day, they did just pay the 19% in taxes, but their overall out-of-pocket expenses went up by over $3,000. So if you did look at that as a, because of that capital gain, what did we have to come out of pocket? That's over 300% from what they actually had a gain on. So these are things just to keep in mind of, a lot of times the gaps are pretty big. So most of the time it's kind of, out of sight, out of mind. But when you're getting close to those limits, then that's where you really need to focus on where should I pull money? How's that going to impact my Maggie? How's it going to impact Medicare, Social Security? But that's just one example right there of getting pushed into a bracket. And you can see they were in a higher bracket, but up to like 200 and some thousand in Maggie, 206, I think, then there is no premium on that. So next we'll talk about RMDs. And this is just a topic because everyone's going to have RMDs if they have a retirement account at some point. Right now it's 73. I think in 10 years it'll be 75 is when you have to start taking withdrawals from that retirement account. So we'll kind of just go through an example of how this can work. So John, he's age 73. He's got an IRA balance of $1 million. He only needs $24,000 pulled out of his IRA in order to supplement his other income. But his RMD amount is $40,650. So he's going to have to pay additional income tax on $16,650. So, and that's something that he didn't need the money. Now he's just going to either put it in a savings account or put it in a brokerage account. And if he wouldn't have had an RMD that high, or he needed the income, then it'd be a moot point. But his income was only $24,000 is what he needed. That's what he's actually pulling out, and got hit with a $40,650 RMD. So it increases his overall taxes. So one thing that you can do in this situation, like we talked about before, is Roth conversions, especially in like prior years before you start taking RMDs. But one thing that I look at is if your RMD amount is going to be more than what you need to pull, then you definitely need a plan for that. So you'll pay taxes on the converted amount, which we talked about earlier, in the year of the conversion, but it could lower that. It's going to lower the IRA balance. And because of that, the RMDs will be lower when they do occur. So if we look at an example of a Roth conversion prior to RMDs, and pretty much a similar situation, but Bob's only 62. He's gonna have to start taking RMDs at 73, which is 12 years from now. So, and same thing, he needs $24,000 a year. And we're gonna assume that the portfolio grows at 5% a year. And so that portfolio value will be about 1.4 million. And that includes pulling out the $24,000 in yearly distributions. But his RMD amount in 2035 will be over $57,000. So if you take that 57,000 minus the 24, he's gonna have to pay additional income tax on $33,000. So if we start now and say, let's reverse engineer the problem. You need $24,000, and what is the IRA balance that we need for the RMD to be that $24,000? In this situation, it'd be about $600,000. So what we would do is convert, say 51,000, and this is just saying in every year, but everybody's situation is a little bit different. But if he converts 51,130 to his Roth each year, he's going to have a taxable distribution each year of 75,000, which that puts him in the 22% tax bracket. His IRA account balance at 73 will be the 600,000, but his Roth IRA account balance at age 73 will be 813,000, and that's at 5% annualized returns. So again, total portfolio value would be 1.4 million, about 600,000 in the traditional, 813 in the Roth. But here's where, when you start looking at the tax analysis. So if he did the conversions, then in the first year at age 73, his account balance would be 600,000. He's going to start taking those RMDs. His total tax bill, and this is just going over 10 years to age 83, would be about $38,000. If he did a traditional IRA, didn't do any conversions, then whenever he turned 73, his account balance would be that 1.4 million. He's going to pay taxes, total tax over that 10-year window of about $121,000. So to kind of break down the math here, that total increase in tax due on the Roth conversions, that 75,612, total tax RMD years with no conversion is $121,000. The total tax in the RMD on the conversions is $38,092, and total tax with conversion is $113,000. So he's still, over the course of that 10-year window, he saved about a little over $7,000 in taxes. But here comes the beauty of that. If he needed the money at a future date, he can always pull that Roth money and it comes out tax-free. But when you're looking at legacy planning and you realize that I'm not gonna need all of this money, and I know that Congress eliminated the stretch IRA or inherited IRA, where people could inherit the IRA from their parents and just stretch it out over their lifetime, taking RMDs based on their life expectancy. What would end up happening in this situation is if they inherited his IRA, they would be paying taxes on that $1.3 million or 1.4, whatever it ends up being. They're gonna have to pay taxes on it. And so if they're already, say, retired as well, and because you're 83, let's say they're in their 60s, they're retired, they're taking Social Security, and they inherit that amount of money. If you look at it over the course of the 10 years that they have to pull it out, it could potentially put them, because they're pulling money out and increasing their income, they're gonna have to pay taxes on the inheritance. They're also gonna have to pay possibly income tax on their Social Security if they're not already, and they could be pushed into a higher Medicare bracket based on their IRMAA. So, but if they convert it into a Roth, if you did that ahead of time and you didn't need the money, because if you did need the money, you can still use it, you can still pull the money out of your Roth tax-free. But if you didn't need the money and they inherited it, well, the beauty of a Roth is they still have to take it out in that 10-year window, but it comes out tax-free. So they're not gonna have to worry about getting pushed into a higher tax bracket. They're not gonna have to worry about Social Security being taxed, or if it already is, increasing that. So it's just a way that really, a little planning goes a long way. And everybody's situation is unique. So, don't just go out there and follow this, saying, well, this is what I should do. It really depends on your situation, your income level, what your goals are. Do you want to spend everything to zero? Do you want to leave a legacy? Do you want to gift a portion of your assets to, say, your church or a nonprofit? Everybody's circumstances are different. And also your plan should be dynamic. And what I mean by that is you can't just create a plan like one time. It's like a once and done thing. Like, okay, this is what I'm going to do for the next 30 years. Things are going to change. Legislation will change. Tax rates can change. We're going to see the Trump tax cuts. There's a sunset provision that next year, tax brackets will be compressed, tax rates will be higher. And of course, that's if nothing happens, if they don't extend those or change it. But as of right now, there's a sunset provision for that. So each time that this happens, you just need to kind of go over, review the plan, make sure everything's on track. And are there any things that I can do now for taxes today and also over the course of my life? So I hope that helped. Kind of went through it pretty quick, and there's a lot of information in there. But if you have any questions, feel free to reach out. You can send us an email, give us a call. You can also go to our website, and even if you're not in the Oklahoma City metro area, we're happy to do a Zoom meeting, answer any questions. All that, the consultations and things, there's no cost to that. So don't think that if I call and ask a question, I'm going to get billed for something. That won't happen. But I hope you enjoyed it. And remember, guys, choose your advisors wisely. Your financial health depends on it.